Hi, I'm Dan Danford. Welcome to another episode of Money Made Easy for DadsDivorce.com. We usually take a question that's been posed by a viewer, and this week's question is among the more confusing that we'll answer, so I'm going to give it my best shot. What is the most amount you can give or receive in a year as a gift without being taxed? I stand to inherit a $15,000 gift from my grandfather, but I was told that if it was more than $13,000, it would be taxed and I wouldn't receive the full $15,000. Is that true? I've just got to tell you, this is a question that people stumble over all the time, and it is a fairly complex answer, but I'm going to try to answer it as simply as possible. First of all, most of those rules that you hear basically pertains to what's called the annual gift exclusion, and that amount is $13,000, and so that's where the number came from that somebody was talking to you about. But the thing that's important to remember is that the $13,000 annual gift exclusion has to do with the giver, not with the receiver. Okay? Now I know that's confusing, but let me kind of give you a little background on that. Under the usual estate tax laws, there's a certain amount of money that one person can leave as part of their estate that is free of federal estate taxes. Okay? That number has been in past years $600,000. It's been $1 million. It's fairly complicated and it changes over time. As a matter of fact, right now in 2010, it doesn't matter because there is no estate tax due for estates in 2010. It was part of a reform that was done a number of years back, and it's set to expire at the end of this year. So while there's no estate tax due for some estate during 2010, it should come back into play in 2011 and subsequent years unless Congress changes it. Okay? But for the purposes of this explanation, let's pretend like it's there for a second. So when somebody dies and they left this sizable estate, a chunk of that estate passes without any estate taxes being paid at all. Now, where this annual exclusion comes into play is if somebody gave a larger amount than that $13,000. Okay, so let's say Grandpa wants to give you a gift while he's alive of $50,000. The difference between the $13,000 and the $50,000, which would be $37,000 in this case, would come off of the exclusion when Grandpa finally does die. Okay, that may be 5 years or 10 years or 20 years down the road. So that's where the $13,000 comes into play. Now, I don't want to make it more complicated than it is, and for purposes of your question, here is the key thing you need to know. No matter how much Grandpa gives you, $50,000 or $15,000 or $30,000, it's not taxable to you anyway. That amount has to do with the eventual estate taxes that might be due on Grandpa's estate. So, Grandpa can leave you or give you as much as he wants, anytime he wants, and it doesn't affect you at all. So that money would come to you without any income taxes. Now, take it a step further. This is even more interesting. Even if Grandpa's estate is so big that his estate will pay estate taxes, the money that comes to you would come to you estate tax free anyway. So in the case of your example, you're going to get $15,000 from your grandfather. Okay? The $13,000, none of that has anything to do with you. You will get the entire $15,000 income tax free. So whoever gave you that information was giving it to you wrong. And it really wouldn't matter whether it was $15,000 or $50,000 or $100,000. When the money comes out of Grandpa's estate as an inheritance, you don't have to pay any taxes on it. Woo, what a relief. So if you have wealthy relatives, this is good news, okay? Now, one more that's kind of related, and then one more that I need to talk about in a little more detail. One more that's kind of related is that life insurance proceeds come to you tax-free as well. So no matter how large the size of the life insurance policy, if somebody dies and you're the beneficiary of that policy, that money comes to you without any kind of inheritance, income tax, or anything else. So if they have a $50,000 or a $500,000 or $1 million life insurance policy, you get the proceeds without having to pay any kind of income taxes on that. What good news. I mean, everybody enjoys hearing that because it's often misperceived. People believe that if they get a life insurance check, they have to pay taxes on it. And no, they do not. Okay, so those are two good rules. Now here's one little caveat to the whole thing, and I think it's important, and that's why I'm going to point it out to you. Money that was never taxed before will probably have to have taxes paid. So if Grandpa has a large IRA account, say, and you're a beneficiary of that IRA account, then taxes will be due out of the money that's paid out of that IRA account. Okay? Same thing's true if Grandpa had a 401k someplace or a tax-sheltered annuity that he'd bought someplace. When that money comes to you, because it's never had taxes paid on it before, you probably will have to pay some income taxes on the proceeds, and that's pretty important. Now, one of the interesting things, and this is good news, and this is why it's so important to consult with somebody before you do stuff with this, is now there is something called an inherited IRA. And what that basically means is if Grandpa left you half of his IRA and it had $100,000 in it, okay, you're entitled to $50,000. Most times you can take that $50,000 and roll it into an IRA account of your own as a beneficiary, and you will have to take some money out based on your life expectancy, but it'll be a relatively small part. And so each year you have to take some of the money out and pay a little taxes on it, but you don't have to take out the full $50,000 and pay a huge income tax on that money. Now again, you can take it out anytime you want. So you can cash it out tomorrow if you want to. You're just going to have to pay income taxes on that money. Most people prefer to keep it in a tax-free environment instead. Now, this is fairly complicated, and I don't want it to be more complicated than your question. I just want to say that when you sit down with any of these situations, whether you're getting an IRA or whether you're getting an inheritance or whether somebody's giving you money as a gift while they're living or after they're gone, it makes sense to sit down with somebody and talk through it so that you don't make bad mistakes. I honestly know of a situation some years ago where a fairly prosperous client died suddenly, and there was a brokerage firm involved, and they went to the spouse right off the bat and got her to set up a new brokerage account and transferred that money from an account to a brokerage account. Well, what the spouse missed and the broker missed is that money was in a retirement plan, an IRA account, and when they passed it directly to the brokerage account, it didn't get the income tax protection that they would have gotten if they'd moved it to another IRA account. And so all of a sudden, at the end of the year, it turned out there was $200,000 or $300,000 that were due as taxes that could have been avoided. Okay? And that was all done very quickly and without really studying the tax consequences, and it could have been avoided or at least postponed for a period of time. So I just want to say, you know, this is a complex area. In your situation, where your grandfather's leaving you a $15,000 inheritance, okay, you don't have to worry about that. You know, take that money, spend it however, because you will not owe income taxes on it. But that's not true of every single circumstance, and it probably ought to be explored before you make final decisions. Okay, I hope that was helpful. Like I said, it's a complicated area, but it's an important area. So I'm glad you asked the question, and I hope we added some meaning with our answer. We'll see you again next week on Money Made Easy. Thank you.